I do kind of feel like the macroeconomic dynamics of between, where growth is going and where inflation is going is just holding yields in a range, right? There's nothing very strong coming out in either growth or inflation at the minute. And I think on both, since April and the threat of the huge tariffs, we've all been fearing some disaster stagflationary kind of event whereby, growth falls off a cliff, inflation spikes, and maybe inflation expectations become de-anchored as well. We're not seeing that yet. The anticipation or the anxiety is still there in the market. The push and pull forces are keeping yields just in a range. And you're right, we've had the announcement of of Uber. We continue to see trade deals getting done, but maybe at tariff rates that are higher than what we expected. And yet all of these things that are happening that ought to be pushing bond yields meaningfully higher if the market believed that there was real momentum and longevity to these trends, they're simply getting stuck at a certain level and retracing again. To me, this is the bond market saying that, we're probably just as worried still about the downside implications to growth, the downside risks to growth of all the policies that we've seen being introduced, but also of the Fed being quite patient to, so far to sit on their hands and do nothing. And these interest rates, the market views as still being overly quite restrictive for the US economy. And therefore, why should long end bond yields become, de-anchored at this point?
Yeah, and I guess the June payrolls that we got just overnight could have justified, backed, supported the case of around a patient Fed. But do you think it can afford to stay patient for the rest of this year? What are your calls around that? And perhaps you can walk us through what the market is going to do once we get a rate cut or once we get a trade agreement or some meaningful framework between the U.S. and some of the major trading partners.
Yeah, look, this is actually a conversation that myself and the team have been having, because it's not really that straightforward. I mean, let's suppose that as we're on air right now, headlines roll across that say all trade deals have been done and they're at tariff rates that are far below what we were fearing a minute ago. What would you do with bonds in that situation? The immediate, I think the immediate knee-jerk reaction you'd want to do with bonds is to buy them, right? Because the inflationary effects from tariffs, they're not really going to come through anymore. And even if they did, we're far more confident that they're going to be short-lived. So from a break-evens perspective, not that much to worry about in the near term about bond yields. But then, we come back to your original topic of the Uber. What is that going to be funded by now? Because there were meant to be huge tariff revenues associated with this trade policy that was going to part fund this ambitious Uber. And then does the market then suddenly switch from being happy about inflation to now being extra anxious about the deficit and where the issuance is going to be along the curve? And therefore, can we really afford to own bonds when there's going to be so much supply coming down the pipe? So even if you had clarity about the tariff position of the US versus the rest of the world this minute, I don't think it's all that straightforward to say what you would do with bonds. And maybe yet another reason why bonds are not breaking out of their range.
And yet nobody is talking about reducing spending. It's not just the problem that the U.S. has. And this, in fact, this one big, beautiful bill is expected to add, more than $3 trillion to the U.S. Debt profile over the long term. And yet the market is not really questioning the fiscal deficit profile anymore, at least for the last few days or so. So when does that become a problem for the market? Again, just like what we saw a few weeks ago.
Yeah. I would separate this, when I think about this issue, about deficits and at what point does a country's deficit start to derail its bond market? I would compare the structural view versus the cyclical view. And the structural view, you see a lot of examples in emerging market economies. So these are economies that constantly have to fight for their fiscal credibility and for generally being conservative and doing the right thing. And when these countries typically in history have exhibited fiscal largesse in any way, you immediately see that the bond markets are the first to get hit. Their currencies are the first to get hit. Now, obviously, a different story for developed markets, and especially for the US, where it has been the world's favored haven currency and haven treasury market for such a long time. So I think when you look at individual countries in the developed market, it's not the same equation as with emerging markets. And just because a country has had large deficits, just because the US has had large deficits in the past, you don't see this one-for-one correlation between a large deficit necessarily means that at that moment in time, treasury yields have to be higher, because the deficit only addresses the supply side of the equation. The demand side of the equation as well, why typically has the US gone into high deficit situations in the past? Well, if they were using fiscal policy in a counter-cyclical way, it would imply that the economy was struggling, and therefore bonds always do what bonds do when the economy is struggling, which is to rally, because the demand side comes in. Like, lots of people want to have haven assets like US treasuries when they think that the economy is going to go into a recession. But I think the equation that's changed, exactly as you've outlined, Sherry, is that it's not just the US that are willing to embark on a large deficit. The deficit mentality has meaningfully shifted since the COVID pandemic. And so when the world at large is willing to run more deficits, willing to fund them more through government issuance, and the demand side of the picture hasn't actually changed that much, as in your net saving economies in the world. You know, we haven't suddenly found a whole swathe of new net savers in the world. Therefore, there's just competing demand on that pool of net savings. And yeah, structurally, we probably are headed for a regime of gradually higher bond yields to compensate for that new supply-demand dynamic. But it's not something I worry too much in the short term.